Hello, and welcome to 3C Money Matters, a podcast for clients, colleagues, and community. I'm Alyce Zollman with the 3C group of Baird, and joining me today as my team co-hosts are Dan Matthews and Kara Endres. Dan, Karen, how are you both this way? I just called you Karen. Dan and Kara, how are you both doing this morning?
I'm better now that you called me by the correct name and you called Kara by the wrong name.
Well, it's wonderful to see both your faces. Kara, how are you this morning?
I am excited to be here talking about one of my favorite topics. So looking forward to it.
Well, many of our clients know Kara and know that she serves as our team's financial and tax planning expert. And probably more than anyone I know, loves digging into a good tax return. So this time of year, as we approach year end and open enrollment season, Kara, can I ask you, is this the most wonderful time of the year for you?
Oh, I love it. Busy looking at every page of that 1040. I love every minute of it.
Well, we're very grateful to have your expertise within our team, and we know our clients are as well. We are very excited today to have our first ever repeat guest on 3C Money Matters, which is Tim Steffen, the Director of Advanced Planning for Baird, who many of our listeners will remember from our most recent episode, which was focused on the One Big Beautiful Bill Act. But Tim is joining us today to help discuss some items, planning considerations, and things as we approach year end that are top of mind for him. So Tim, thank you for joining us again. How are you this morning?
I'm wonderful. It's good to be with you all again.
Well, we very much appreciate it. And take it you're joining us again from beautiful Milwaukee.
I am on the shores of Lake Michigan and downtown Milwaukee as we speak.
Wonderful. Perhaps for your third time as guest, we'll get you down to Bloomington in person. But
live and in person, I'd love it.
As I mentioned, go ahead, Dan.
I was going to say one thing. I did want to say that I think you got a little bit of your revenge because last time before you were on, I think Illinois was going to be playing IU in football, and we absolutely destroyed Illinois, which I believe is your alma mater. But last night, the Pacers got beat by the Bucks by 2 points.
That's right. Yeah, last week's shot, as I recall. Yeah, I'm actually more of a Bulls fan, but I do root for the Bucks, and it's good to see them competitive. Good to see them playing well.
It's a fun time of year for sports on a lot of levels, but our listeners may remember from our previous episode that as the Director of Advanced Planning at Baird, he helps our clients and our advisors and teams understand and interpret tax planning, estate planning, and financial planning topics, both simple and complex. And again, as we approach year end, Tim is a busy guy talking about a lot of things that tend to come up this time of year, but as Tim will often tell you, planning considerations aren't something we should just be thinking about at year end, but as the deadline approaches, something that tends to pop up. So, Tim, with that, with the passage of the OBBBA, which we covered in great detail in our last episode, but with that in mind and beyond, as we approach the end of the year, what are you talking about most with clients and advisors?
Sure. Yeah. It's just always start with a status check. Let's just kind of see where we're at for this year. Do a quick check-in of what is income looking like? What are deductions looking like? Where I'm at from a capital gain loss standpoint. Have I met required minimum distributions? All these little things. Have I maximized my retirement contributions? All those little things. Just get all the blocking and tackling stuff done now. And then from there, we can figure out, all right, what's left to do? What else can we take advantage of this year? In particular, with an eye towards OBBBA and all those new deductions that are out there, making sure you're not doing anything that might cause you to lose the benefit of something new that's out there, whether it's the higher SALT deduction or the senior deduction or any of the other new kind of unique deductions that are out there. Let's find out where we are now and then what's left to do and what might be the impact of some of those things. There's plenty of things you can be doing this time of year to help manage your tax liability, both for this year and into the future.
Thank you, Tim. And I know we touched on this in our last episode, but with the OBBBA, and can you give us 2 or 3 of the new deductions that are most likely to impact the greatest number of people to be aware of?
Probably the one that's going to have the most impact will be the increase in the state and local tax deduction limitation. For the last several years, you've been able to only deduct $10,000 of the taxes you pay to your state, whether that's income tax or property tax or sales tax, whatever it might be. Now that cap is up to $40,000. So it's a much larger limit on what you can deduct, enough maybe that to even get you over the standard deduction just on that number alone. The trick is, though, that number goes down once income hits a certain threshold. So if you're a taxpayer with income over $500,000, you begin to lose some of that increase. So as your income goes up and passes over 500, now you've got not only the tax on that income, but also the deduction you may be losing. So you got to be really careful with that one. Another deduction that a lot of people are asking about this year is a new one for anyone who's over age 65, beginning at the end of this year. So if you're 65 as of 12/31/25, you're eligible for a new $6,000 deduction. If you're married and you're both over that, you each get a $6,000 deduction. But again, subject to that phase out. If income crosses a certain threshold, a much lower threshold in this case, $150,000 for a married couple, you begin to lose some of that deduction. So again, same kind of thing. As your income passes over $150,000, you may be careful about, is this extra income going to be more expensive to me from a tax standpoint? Because I got the tax on that plus the loss deduction. Then you got all the unique things that are out there, the tip and overtime and auto loan interest deduction, all those kind of unique ones that are out there. And then, planning for a couple of new ones coming next year too. So we'll talk more about those as we get into, more about some of the planning between the 2 years. But I'd say that the two biggest ones I get asked about, the SALT deduction and the senior deduction.
So Tim, as someone is maybe doing a status check at this point in the year, what are some things they could consider doing if they find themselves creeping close to an income threshold where they might miss out on some of those new deduction opportunities?
Yeah, there aren't a lot of silver bullets to kind of solve that. You can, if you've got if your capital gains, you get net capital gains for the year, you could maybe recognize some losses in your portfolio if you have any to offset those. If you have additional RMD distributions you have to take before the end of the year, you can maybe do those as a qualified charitable distribution. That won't count towards income. Again, make sure you've maximized things like 401k and health savings account and some of those other contributions that you can do. The big thing is just, to the extent you can, and not a lot of people can control this, but slow the income down. Maybe don't do the Roth conversion, or just understand that if you do the Roth conversion, it might cost you a little bit more. Might be a little bit more expensive to do it because you're going to maybe lose some deduction as a result. So if you're already over the threshold, quite honestly, there's not a lot you can do to bring yourself back down. Yeah, capital losses, and if you're a business owner, maybe recognize some expenses or something to offset some income. Not a lot of magic things you could do there, unfortunately.
Tim, you touched on Roth conversions. That's a topic we do find ourselves often talking about with clients or getting questions about, but tell us more about that. What is a Roth conversion and what's the rationale behind it?
Oh, Roth conversions, everybody's favorite topic. So, a Roth account is it's not that new anymore. It's been around almost 30 years that we've had these accounts now. It's an account like a traditional IRA, except all the dollars that come out of it are ultimately completely tax-free. So, who doesn't love tax-free income in retirement, right? So the idea is that you want to try and get as much money, perhaps, into those accounts as you can. You can contribute to them directly, but most people have problems with that because there are some low income thresholds that maybe prevent the direct contribution, or maybe you're retired and you don't have income to contribute. The other option is what they call a conversion, where you take money out of a traditional IRA, you pay tax on it, you move it to the Roth IRA, and from that point forward, it never becomes taxable again. And you don't have to take money out of it. There's no required minimum distributions on a Roth IRA. So once the money goes in there, it can sit in that Roth account for the rest of your life, your spouse's life, and even for a period of time after you and your spouse have both passed. So it's a great way to generate some tax-deferred and tax-free income. It's not easy to get to. There's a cost to doing that. And the question is always, is the cost to do that low enough to justify paying it up front in order to get that tax-free income on the backside? And that's really the analysis we have to go into. And there's a number of different things we look at to try and evaluate that. But it's a popular one this time of year as people are trying to maybe, fill up a lower tax bracket or offset maybe some deductions that they're claiming, something like that. So it's a big one this time of year.
Kara, I'll ask you, because I'm confident that this topic comes up in a lot of conversations, probably daily for you working with our clients. But in your view, who benefits most from a Roth conversion?
Yeah, so I would say most of those conversations that I'm having are those that are early in retirement. So on the earlier side of retirement, when you haven't hit required minimum distribution yet, a lot of our clients are in a lower tax bracket those early years. So we try to fill up those projected tax brackets of where they're going to be when they hit required minimum distribution status, take advantage of those lower tax rates early in retirement instead of waiting until you're 75 and you're right back into the same tax bracket that you were in during your working years.
Alyce, you brought up to me earlier today about the first Roth conversion that was performed, and it was actually before Roth IRAs were invented. Could you elaborate on that?
I could not. I think I need you to tell me more about that. What was that, Dan?
Well, actually, in the late 80s, Van Halen was the first group to actually have a Roth conversion. They actually switched lead singers from David Lee Roth to Sammy Hagar. And I'm not sure that it was a good move. I did like Ice Cream Man and Jump, but, everybody has their own opinion about that first Roth conversion.
So that was the
Dan,
first.
You had me waiting with bated breath on that one. I was dying to find out what that was going to be. I thought I'd missed something.
That was the first known recorded Roth conversion in history. I do have to ask, was Sammy Hagar the lead singer on the song that was in the Clear Pepsi commercial in the 90s? If you guys remember that?
I don't recall that song.
Maybe not. Maybe not. I'm sure our dozens of listeners are on pins and needles wondering the answer to that question. But in any case, since we were on the topic of Roth conversions, this might be a good time to transition to thinking about clients that have or will inherit IRAs or inherited Roth IRAs. And Tim, I know you've touched on this in some presentations recently, but there were some pretty sizable rule changes for children or non-spouse inheritors of IRAs and Roths 5 years ago, but some even more updated rules surrounding that. So could you touch on some of the rules surrounding those who will inherit IRAs?
Yeah, so there's it's hard to call it a new set of rules taking effect this year because it was enacted 6 years ago, but this is the year it actually first takes effect. So it's the oldest new rule we've ever talked about. Back in 2019, Congress passed a bill that changed the way beneficiaries have to treat inherited retirement accounts. In the past, they took annual distributions every year after the date of death of the owner for the rest of the beneficiary's life. Back in 2019, though, a bill called the Secure Act changed all that and invented what we now refer to as the 10-year rule. And it says those beneficiaries, with some exceptions, but for the most part, most beneficiaries now have to take distributions out of those accounts over a 10-year period. And at the end of that 10th year, that account has to be fully empty. There are some exceptions. You mentioned spouses, minor children, disabled and unhealthy individuals. They get some exceptions. They get the old stretch rules. They can take distributions over their lifetime. But for most adult, healthy beneficiaries of an inherited retirement account, they are subject to the 10-year rule. There was a lot of uncertainty in this rule when it first came about, so the IRS kind of delayed the impact of it for a few years. But last summer of 2024, they said, okay, 2025, these rules are fully in effect, and you need to start taking distributions in many cases. So yes, this is the first year. If you inherited a retirement account in 2020 or later, there's a very good chance you have to take a distribution from it this year and maybe have a very short window during which you have to empty that account. So the idea of tax planning around here is going to be really important.
And potentially, as folks consider the next generation and their children inheriting pre-tax IRAs, that's another example where Roth conversions could make sense, potentially to benefit the parent or the grandparent, but probably more importantly, the next generation.
It's not unusual for parents or grandparents to be in a much lower tax bracket than their kids will be when they inherit a retirement account. So it may make sense for mom and dad or grandma and grandpa to write that check today and then leave that tax-free money to their kids or grandkids. The person paying the taxes won't appreciate it, but boy, that beneficiary will really appreciate that tax-free gift when you pass. So there's some value there.
Yeah. Great point. Tim, another point as we approach year end, many of our clients are very charitably inclined and want to give back in meaningful ways to their community or organizations they care about. And we generally encourage anybody with a pre-tax IRA that's over the age of 70 and a half to consider qualified charitable distributions, or QCDs, for the majority of their charitable giving. Can you talk a bit about QCDs, what they are, where you see them being used most?
Sure. So a QCD, qualified charitable distribution, is a rule that came about, actually it's been around for a long time, and it kind of went in and out of the tax code for a bit, but it's been permanent now for a long time. It's the ability to make a gift to charity directly from your traditional IRA, and it has to be a traditional IRA. You can't do it from a 401k or any other kind of IRA or any other kind of accounts. It's got to be an IRA. Make a distribution from the IRA directly to charity. That distribution is not considered taxable income to you. Now, you don't also get a charitable deduction for it because you're getting it in the form of tax-free income, but it can be a way to move dollars out of your IRA to charity at no tax cost. Where it becomes even more valuable is when you turn RMD age, whether that's 72, 73, 75, whatever year you were born that will dictate that. You may have to take money out of your IRA that you find out you don't really need. It's more income than you need to live on, and you'd like to give it to charity. By doing this distribution direct from the IRA to charity, it counts towards that required distribution, but with no tax cost. So to your point, if people are charitably inclined and they have IRA dollars they don't think they're going to need during their lifetime, this could be a really tax-efficient way to support a cause that's important to you.
And Tim, I think I'm correct in saying, but please correct me if I'm not, to utilize a qualified charitable distribution has to be done from an IRA. Cannot be done from a 401k or a 403b,
Yep.
an employer retirement plan. Is that correct?
That's exactly right. Traditional IRAs, where we typically see them, you can in some cases do them from a simple or SEP IRA. You wouldn't do it from a Roth IRA, and definitely not available from a 401k, 403b, 457, any of those employer type plans. Definitely can't do that. Now you can roll the dollars out of there to your traditional IRA and then do a distribution from that account, but not directly from the employer plan.
Tim, in our last episode focused on the OBBBA, you touched on some changes, again, staying on the charitable contribution note, and deduction changes, limits to be aware of. This would be for charitable giving outside of QCDs from IRAs that we just discussed. Could you touch on those again and how that might impact giving in 2025 versus 2026?
So there are 3 rules that take effect in 2026 that will all impact the timing of charitable giving between these 2 years. 2 of those are limitations on the benefit of your charitable gifts. For high income taxpayers, those are the top bracket. There's a cap on the benefit of all itemized deductions. Typically, benefit or deductions at the highest bracket save you 37% in taxes. Next year, they'll be limited to 35%. There's also a new floor on charitable gifts specifically that says gifts have to be more than 0.5% of your income before they become actually deductible. So those 2 things combined are limiting the value of deductions for people who do a lot of giving at higher income levels next year. Because of that, it may make sense to bring those deductions from 26 into 2025 and accelerate some of that gifting. You may get, all things being equal, a little bit more tax value by doing them this year than you would next year. On the other hand, there is another rule taking effect next year that allows those who do smaller gifting, who don't itemize, who use the standard deduction and therefore don't get a direct tax benefit for their charitable gifts. There will be a new, what they're calling an above the line deduction. It's one that you get for those who take the standard deduction. And that will be for cash gifts to a public charity of up to $1,000 if you're single, $2,000 if you're married. So for those who do smaller amounts of gifting, who don't typically itemize their gifts, their deductions this year, they may find it's more valuable to push those small gifts out of 25 and into 26 when they can take advantage of that new deduction next year. So it's a very individual thing. There are cases for accelerating and for deferring. You just got to make sure you understand what is the best way to maximize the value of your charitable gift. You're all doing it theoretically, and your primary focus is to support the organization you want, but we all want to maximize our tax benefits too. And from that standpoint, really be careful about what's the right way and right timing to make those gifts.
Kara, I wanted to ask you, this is, of course, open enrollment season for many of us that work for companies and have employee benefits, but Tim's obviously touched on a lot of year-end things to consider. Any other points you find yourself talking about with clients quite frequently this time of year?
Yeah, especially around open enrollment. Like you said, we are in that kind of heavy season for open enrollment. So I would encourage you to really look at your health insurance options as you're electing your benefits. And consider if you have available to you a high deductible plan with a health savings account, just really dig into it and look and see if that makes sense for you. A health savings account is the only bucket out there that is triple tax efficient. So your contributions go in pre-tax, growth is tax deferred, and if used for healthcare, it distributes completely tax free. So it's a bucket of dollars that you may never pay taxes on, and that's just not typically the case. We counsel our clients to try to cash flow healthcare expenses during their working years the best they can. Max out the HSA, invest it, let it grow, take advantage of that tax deferred growth. And then one little known rule about HSAs is once you're 65, that 10% penalty goes away. So you could use your HSA during your retirement years after age 65 for really anything. You would have to pay taxes if it's not for healthcare, but that 10% penalty goes away. So there's just a lot of value in that health savings account. So I would explore that option if you have it available.
Great point, Kara, and something I know you bring up throughout the year with clients, which is always appreciated. So Tim, Kara, wonderful information. Dan, great point on the David Lee Roth conversion. But as we close out this episode, Tim, any additional points you feel are important to make or that you want to convey to our listeners?
Well, again, I think this is the time of year where you just really need to evaluate where you're at. Year-end planning is not a year-end game. It's a year-long game. So you don't necessarily have to wait till November, December to do this. These things we're talking about are things that can be done all throughout the year. Roth conversions, QCDs, HSAs, all of them. The other thing I always remind people of is that year-end planning is a multi-year game. Whatever you do now is something you can't do next year. So if it makes more sense to push the conversion into next year, accelerate the charitable gift of this year, defer a capital gain into next year, you should do this as a multi-year plan and take a look at what is the best opportunity for me to maximize the tax benefit, whatever it is I'm doing. And maybe it's this year, maybe it's in January, maybe it's a multi-year thing. So it's not a set it and forget it. It's not we took one look at this. You got to look at this over a longer period of time. There are lots of planning opportunities out there. You don't want to miss out.
Great point.
I have one quick question about donor advised funds, and I wanted to hear Tim's thoughts on when you have a business sale or you have a rental property or things like that are selling that are at huge gains. Do you feel like donor advised funds are a good way to eliminate some of that tax burden and then have charitable funds set aside for future giving? What are your thoughts?
Donor advised funds are a fantastic tool. I always like to remind people, donor advised funds in and of themselves don't provide any magical tax benefits that giving directly to another charity wouldn't do. If you have a charity you want to support right now, give them the money today and let them enjoy it and use it for their fun, use it for their purposes. But if from a tax standpoint, you want to accelerate some gifts, do multi-year worth of gifting at one time, and you don't know exactly where you want those dollars to go, or you want to spread it out over time, that's where the donor advised fund really provides some value. It's an ideal place to accelerate the tax benefit by getting the money in there today, and then you control the funds. You can't get them back. It's a completed gift, but you control it. You can invest it, you can manage it, and over time, you make distributions out to the charities that are important to you. So it's a great way to accelerate the tax benefit while maintaining some control over the assets. And that's the real value of a donor advised fund.
Very good. Well, Tim, as always, we appreciate you joining us for a second episode. It's wonderful to have your expertise and thoughts. For our listeners, in addition to the great work and help that Tim provides our clients and our teams, you can also find his commentary and expertise in national media publications like the Wall Street Journal and CNBC. So, Tim, once again, thanks so much for joining us. Dan, Kara, wonderful to have you both alongside me today. Thank you. And to our listeners, thank you for joining us. For 3C Money Matters, we'll catch you next time.
This broadcast contains the current opinions of the host and are subject to change. The broadcast is provided for informational purposes only, is not a complete analysis of every material fact regarding any company, industry, or security, and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Robert W. Baird & Company Incorporated, member SIPC.